Hello, Steve Lentz here with the Prepared Mind and the Market Likelihood Report for Friday, March 18th, going into Monday, the 21st. All right, and so this is connected with the blog at the Prepared Mind at discoveroptions.com. You can click the blog link and go straight to it. You'll see Frank Fahey's blog entry here for coming up on Monday the 21st. Lots of good things there, lots of earnings information, including a list of candidates for double calendars based upon those earnings. So go ahead and take a look at that report. Pages and pages of good information, including economic reports coming up this week, volatility outlook by Frank, etc. So take a look at that, and we're going to move forward with the market likelihood report, which comes from technical analysis action on the price chart. Here is the action ending on Friday the 18th. And we examine really 5 different things: price action, trend, overbought and oversold, daily range. That's 4 things, right? That's 4 things, right? Price action has a few things to it. We examine the relationship from the high from Friday to Thursday, the relationship of the lows from Friday to Thursday. In this case, we had higher highs and higher lows going into Friday. We examine the relationship of the open to close for both of those days. In this case, close was higher than the open on both days. We examine the trend. In this case, we are above the 65-day moving average, so we're in an uptrend. On the stochastic 15.3, we are definitely in the overbought territory, over 70. So there's that consideration as well. And then the daily range declined from Friday, on Friday from Thursday. The daily range was much less on Friday than on Thursday. So you combine all those parameters and you get a very specific technical scenario. And the question here is since January of 2000, how often has this same scenario occurred, and what did the market do? All right, so if we know how many times this exact scenario has occurred in the past, perhaps we can then look at the past to tell what it might do moving forward from, starting on Monday. So that's what we seek to do here. And we use what we call an edge analysis. And I do this every week. I'll go through it very quickly. First, we seek to understand the historical distribution of price. Then we look at the distribution of price after a technical scenario develops, like the one ending Friday. Then if the two are different, we assume that a potential tradable edge exists, all right, at that point. So let's take a look at understanding the historical distribution of price. We use 3 different sets of volatility bands. All right, these are set a standard deviation away, set out 5, 10, and 15 bars in the future. All right, we use a 20-day historical volatility, which we at OptionView call statistical volatility, and these are set in a log normal fashion. As an example, here are some 10-day volatility bands that we set from the close. And the question here is from this close, will price go up and hit the upper one, the lower band, or stay in the middle? And in this case, you can see price clearly went up and struck the upper band from there to here, right? Actually, the next day is when it occurred. And then from this close, did it go down and hit the lower one, or strike the upper one, or stay in the middle? In this case, it definitely stayed in the middle, although here you could see it tried to come down and hit the band. Close but no cigar. So what we do then is we look at every close going back to January of 2000, and we record how often price struck the upper, the lower, 15, 10, and 5-day bands. And we record that for every close going back that far. In this case, for the SPX ending 318, from all the closes, it hit the upper 5-day band roughly 29.5% of the time. It hit the upper 10-day band 23% of the time. The upper 15-day band, well, roughly 23% of the time. On the downside, it hit the lower band roughly 30% of the time. 10-day bar or 10 bar lower band, 29.65, and the lower 15-day band, about 32.5% of the time. So this is the historical distribution of price. Okay, so what we're going to do now is look at a technical scenario like the one that developed on Friday, and we're going to examine that. And here's a chart showing this situation. We have the stochastic, we have the average true range, and when that exact same situation occurred, I painted it in red like you can see here. All right, did we do that in red? Yep, did it in red. And so what we're going to do is go back in time and look at what happened at the close, just examining Friday at the close. What if on Monday or the next day price goes above the high of that bar? What if it goes above Friday's high? What's the distribution if it exceeds the high of this bar on average? What if it goes below the low of the bar? So we're going to examine 3 different distributions, and so here we are. Okay, here's the historical distribution. Okay, at the close with this scenario, 219 times this signal occurred. Now we're not counting consecutive signals. Okay, we have to have non-consecutive signals. But you could see here, after this scenario developed, it hit the upper 5-day band 14.6% of the time, which is a lot less than the 29.5. Okay, the upper 10, look at that, about 17% compared to 23. About 18% compared to about 23% on the historical distribution. So we can clearly see there's a bias against price going up another standard deviation at this point and touching those upper bands. On the lower side, again, lower levels than historical across the board. You can see this basically about 23 compared to 30, about 23 compared to 30, about 22 compared to 32. So clearly it would appear that volatility is going to decline on average. Now, if price exceeds the high on Monday, you could see here that it's going to go up and hit the upper bands just an extra percentage point or so. Not much, but still far less than the historical. And on the downside, clearly much less than the historical. Now, if price goes below the low, we can see then we're still below historical, although not as much. It would appear that if price exceeds Friday's low, volatility will ramp up and go back up to about the historical levels on the upside, but still a little bit less than normal on the downside. Okay, so definitely if price ascends above Friday's high, you can really look for lowering volatility, meaning that the market, on average, if history plays out, strong probability that the price will stay within the bands over the next 5, 10, and 15 days, that lower volatility than what we have seen historically there. Okay, here's the Metastock code for the setup that we have on Friday's close. Now, for those of you that are options traders, we're just going to note here where implied volatility is relative to statistical. Implied volatility is much less than statistical. On average, though, when you go back in time, implied is quite often higher than statistical. So we are in a season right now where the implied volatility is plummeting and is still way underneath where statistical is. Okay, now what we're going to do then is recast those bands, and instead of using a 20-day statistical number, we're instead going to use the skew adjusted VIX to determine the width of those bands 5, 10, and 15 days out. Now, because the VIX is on average higher than statistical, okay, follow me here, the bands are going to be wider than statistically based bands. Therefore, they will get struck on average a lower percentage of the time. Now, Down here at the bottom, you can see statistical that we used. The statistical currently is at 14.2. If you were to adjust the VIX, okay, for the upside volatility versus the downside volatility using the SIBO skew, we know that on average, the index goes up less volatility than it goes down, right? And that's what the skew is we're trying to adjust for here. The upside bands are going to be a little bit closer than the downside bands because on average, the index falls faster than it rises. And that's what we're reflecting here with these bands. And so when we do that, you can see then the historical distribution, a bit lower than using statistical. Still though, you could see on average, okay, on this technical setup, the upside bands are getting struck roughly 1 time in 10 on average, just looking at the upside bands, 0.9 or 9%, 10%, etc. On the downside, similarly, boy, sometimes it goes a bit lower there, but generally a little bit higher, roughly 15% on some of these, 13, 15, 11, etc. A little bit higher on the downside bands. So what we're going to do is if you were to take the skew adjusted VIX numbers and say went to the 12.1 to the upside, 15.9 to the downside, and let's say you're going to go out about 3 weeks. Okay, 1 time in 10 on the upside. On the downside, it looks like, about 15% of the time those the bands will get struck. So on the upside, you could use a 12.1% calculation for the vol on the upside. That puts you at a short strike of about 2110, say creating a condor here. If you were to put in the downside using a 15.9, like the skew adjusted VIX had us, we're down here at about the short of 1970. That gives you a condor in option view model just like this. And you could see on the upside, if you're trying to make 17%, and then 1 time in 10, it looks like you might lose roughly 33% of the time. You could see that you have an edge on the upside movement if it hits this 1 time in 10. On the downside, it's going to strike this roughly 15% of the time. It'll stay in between roughly 85 to 90% of the time. You can then see on average what your edge here is using the risk-reward analysis modeled here in option view. Okay, so that concludes this. That's just a suggested trade. Thank you very much. We look forward to seeing you next week. If you have any questions, call us up at Discover Options or send us an email, steve@discoveroptions.com. Take care. Bye-bye.